Okay, welcome back to Infinite Investors, the home for all new and non-investors. In this video, I'm going to explain why the whole concept of beating the market is absolutely irrelevant and why I believe, in my personal opinion, that many people look at this in fundamentally the wrong way. So if you want to know more, please like, please comment, please subscribe, help the channel get to 3,000 subscribers and we can get the whole world of investing out to more people in a clear, simple and transparent manner. But first, let's get into this. Did you beat the market? Listen, in many comments and in many messages, I get two questions stroke statements. Number one is, did you beat the market? For someone like me who shares his portfolio, who shares his returns, shares the amount of dividends, the capital gains, the profit, the loss, etc. on a consistent basis, there's a positive side to it, but also there is the other side where people say, did you beat the market? I might say, I've received X amount in dividends, but did you beat the market? I might say, look, I got this amount in a capital gain return on this particular stock, but did you beat the market? Did you beat it, fam? Like, did you beat it though? And I'm thinking, yo, it's like you're talking about gal. Like, did you beat it, fam? Did you beat it, fam? I'm like, look, calm down. Let's actually try to understand what beating the market actually means before I start answering the question whether or not I beat the market. The second thing I always get is, you would have made more in an ETF. I also find this even a worse question than, or worse statement than, the did you beat the market question. And the reason why is because if you don't do the calculations, then actually what are you even talking about? Because when you're talking about ETFs, which ETF are you referring to? Even if you're referring to two ETFs that track the exact same stock, some might be optimized, some might be full replication. One might be accumulating, one might be distributing and reinvesting. They might have two different ongoing charges or expense ratios. And also the primary factor, which is the reason why I wanted to create this video, is I personally believe that how you invest has a bigger impact than actually what you choose to invest in. And so those two statements I'm definitely going to dispel in the course of the video. So first, let's just set the scene. I'm on Investopedia and there's an article which says, what does it mean when people say, did you beat the market? And here it basically shows beating the market in quotation marks. And the very first thing it says is a difficult phrase to analyze. And it is an absolutely difficult phrase to analyze, and we're going to find out why. It can be used to refer to two different situations, but I'm only going to refer to the first situation as that's what we're talking about in today's video, but that still is very difficult. So an investor, portfolio manager, fund or other investment specialist produces a better return than a market average. The market average can be calculated in many ways. Let's pause on that and let's just marinate, let that one marinate and sink in right there. But usually a benchmark such as the S&P 500 or the Dow Jones Industrial Average Index is a good representation of the market average. If your returns exceed the percentage return of the chosen benchmark, so we talked about many ways and also of the chosen benchmark you want to use, let that one marinate as well, you have beaten the market. So in this context, I'm going to do my calculations to basically prove or disprove whether or not I've beaten the market, and prove or disprove, my personal opinion on where I think the whole concept of beating the market is absolutely irrelevant. I think it gets a lot of investors just caught up in the hype and the hysteria, and actually it really gives you no real benefit in terms of how well you're doing, personally speaking. So in this context, the chosen benchmark that I'm using is the FTSE 100, and I'm taking the FTSE 100 ISF, which is the iShares distributing FTSE 100 performance, and that's what I'm basically going to compare my portfolio to in a number of different ways. So let's start with my portfolio. Over the course of this year, I invested £22,782. I've had a return of 2,838 pounds, which is a total return of £25,620, which is an 11.01% return. If we want to go to Simply Wall Street, you can see 11.01% return is the return that's basically sitting there at the current moment. Now, the FTSE 100 ISF, If I invested £22,782 up front, we're talking about lump sum investing, my total return would have been £4,174. That would have been £26,956 as a total return, and that is basically the 18.32%, which sits at £1,336 more than I would have made in my current portfolio. Now, let's look at it. We can see that on just ETF, the iShares ISF ticker symbol currently in 2019 yielded 18.32%, and also it shows here this is what the monthly returns would have been. My issue number one, if we're going to make a countdown of them, is that when people are questioning whether or not my portfolio beat the market, what they're comparing is this 18.32% as an example, if this is the chosen benchmark they're using, with my 11.01%, and I'm going to show you why that's a fundamentally wrong and a fundamentally dangerous thing to do as well, because if you did that for say this year, it would actually look like, you know, everyone's beating the market if you made even just £1 of a return, and obviously that's not going to be the case. So that's what I'm also going to do. Now, when we go back to my spreadsheet, what I basically want to try and explain is that I personally believe that a bigger factor in terms of actually comparing your performance to, say, a market average or an index, if that's what you want to do, is not only choosing the benchmark, but also calculating how you chose to invest. So the way you choose to invest for me has a bigger impact than obviously, you know, what you choose to invest in. So in this context, I've basically done it from a dollar cost averaging perspective, because I basically dollar cost average my portfolio throughout the course of the year. So what we can basically see is here is £22,782, the same initial investment over the course of 12 months is on average £18.99 per month. Now obviously each month could be different. One month I might do £1,800, another month I might do £2,000, etc., etc. So I can't obviously look at all of the different permutations, but we're going to just take on average £18.99 over the course of a monthly basis. Here I've basically listed the monthly returns, the same monthly returns that you see here. So you can see that the first month was a 3.6% return, the second month was a 2.2% return. You can see the first month 3.6% return, the second month 2.2% return, and I've basically modeled that all the way through as well. What I've then basically done is say, look, to keep this absolutely simple, what is the average return on a monthly basis? And the average return on a monthly basis is 1.44%. So with the money that I have in the FTSE 100 ISF fund, on average, every single month, I would earn 1.44% if we're looking retrospectively back at 2019. So let's look at some of the sums. I start with an 18.99 investment. At 1.44%, I would have made £27.34 profit. My total return for month one would have been 19.25, and that is basically the first month done. Now in the second month, it would be 19.25 plus another 18.99. At 1.44%, that's £55, and then my total return will be 3879. For month three, 3879 plus another 1899 would be 5778. My return of 1.44% on that would be £83, and my total return would be 5861. And you can see that going all the way through to month 12, which basically then would leave me with £25,031.15. Now, let's then look at that. If I invested £22,782 into the ISF iShares FTSE 100 ETF, my return would have been £2,249, and my total return would be 25,031, as you can see here, which is a 9.87% return, and is £588 less than what I made in my current portfolio. Because what I'm basically doing here is comparing what I consider to be apples for apples. I'm comparing me dollar cost averaging into my current portfolio versus me dollar cost averaging into the FTSE 100 fund. And in both contexts, in that context, if I did the same type of investment strategy, I would have actually returned a bigger return in my current portfolio than I would have done in the FTSE 100. Rather than comparing the FTSE 100 total annual return versus my investment, for me is an apples to pears or an apples to dragon fruit comparison, because actually if I invested as a lump sum into my portfolio, I significantly believe that I would have made a much better return. So let's do that calculation, and that's what we're going to basically look at here. So right here you can see all of the stocks that I currently hold. Now obviously I've held stocks previously that I've currently sold, and I've also bought stocks recently that I haven't held for the over the course of the year. So what I've basically done here is I've eliminated all of the stocks that I haven't had since the beginning of the year, because I feel that that's going to skew the figures, and actually it would skew the figures in my favor. So you should be happy that I'm doing this, because look at Advanced Micro Dev, which had yielded, I don't know what, 114% over the course of the year. Shopify did again another like 100% or whatever over the course of the year, etc. And also I've got rid of the ones that I currently don't hold no more, such as Trig, Renewable, Robo Global, etc., etc. Now what you can basically see here is that I'm left with these stocks here: Imperial Brands, Barclays, Aviva, Lloyds, Taylor Wimpey, Barrett, Centamin, Legal and General, and Virgin Money UK. In that context, I'm showing you here that these stocks are ones that I've held since the beginning of the year, and I've held to this current juncture at this current moment. Now Imperial Brands, Barclays, Aviva, Lloyds, Taylor Wimpey, Barrett, Centamin, Legal, General, Virgin Money UK, I've held from the beginning right up until this moment. So all I'm basically doing is saying these are the best ones to basically make the argument for. And so let's look at the average for these performers. So if we go to Simply Wall Street, what we can basically find is that, let's say we take Imperial Brands, we can basically see, once it decides to load, that my performance for Imperial Brands, or Imperial Brands performance over the course of the last year, is 19.4%, or minus 19.4%, and including dividends is minus 11.3%. And you can see here minus 19.4%, including dividends minus 11.3%. If we take another example, let's look at one of the stocks that have done well over the course of the year just to compare. And let's say Barrett Development, which has been one of my favorite stocks. You can see that over the year it's a 66.7% performance, and including dividends is 80.3% performance. And you can see that here 66.7% and including dividends 80.3% performance. So on average, excluding dividends, my performance with this current portfolio would have been 24.03%, and including dividends my performance would have been 32.62%. So that's really the truer figure, because obviously dividends count in terms of your total performance. But let's now run these figures again. If I invested £22,782 as a lump sum, excluding dividends, I would have made £5,475. My total return would have been £28,257. If I invested £22,782 up front, including dividends at 32.62%, my return would have been £7,431, and my total return would be £30,213. And what I've basically done here is now compared that to all of the three different scenarios you can see here. So the very first comparison is this portfolio as a lump sum versus me. So versus me dollar cost averaging into the exact same stocks. And what you can see here is, if I did it as a lump sum investment versus dollar cost averaging, I would have made 2,637 or 3,258 including dividends. And this for me showcases very, very clearly that I chose the exact same stocks, but in fact, the way I've chosen to invest, dollar cost averaging, is more of a risk averse approach. And what that basically means is that I tend to buy at higher prices if my stock picks are good and things are going in the right direction. And therefore, I make a lower return overall because I'm buying less shares at obviously a more of a cost. If I compare this current portfolio now to the FTSE 100 versus as a dollar cost average, you can find that I would have made 3,226 or £5,182. So obviously I would have made way more than dollar cost averaging into the FTSE 100. And let's do more of a like for like comparison and more of an apples to apples comparison. My portfolio as a lump sum versus the FTSE 100 as a lump sum, and you can see that in that context my stock picks were better, because I would have made 3,258 including dividends versus a total return of 18.32% or £26,956 because I would have made 30,215. So I would have made £3,258 more. So for me, what I'm basically trying to illustrate here is that when you're talking about beating the market, if that is really such an important concept to you that you have to really work out and you really want to know whether or not you beat the market, my primary guidance to you is that you first look at not only which market you're deciding to choose, if we go back to the one that you're looking at choosing, but also how you decided to invest into it. Because if you look at how you invested into it versus investing into the ETF versus investing into your current portfolio, then you've got a bit more of a true reflection on the performance. The second thing is actually what is your chosen benchmark, because in this context you can find that I've got say 9 stocks that are say FTSE 100 stocks, but I've also got a number of stocks that are FTSE 250 stocks. Also, I've got stocks that aren't in the FTSE 250. I've also got many stocks that are US stocks as well. So do I choose the S&P 500? Do I choose the Dow Jones? Do I choose the Nasdaq? Do I choose the FTSE 100? Do I choose the FTSE 250? What is my chosen benchmark? Because you will actually find that depending on which benchmark you choose, your idea of beating the market varies wildly compared to them, and that's something to sort of bear in mind. And for me personally, again, the last thing I really want to say is you would have made more in an ETF. It all depends on obviously which ETF that you choose and which ETF, because this is the performance of this FTSE 100 ETF. But I guarantee you, I could probably do a bit of digging and find an ETF that's a FTSE 100 ETF that probably had a much less or a greater return than 18.32%, which then would completely change the whole dynamics of this argument. So my point to you is I think the whole concept of beating the market is absolutely irrelevant. What I think is more important is actually deciding what type of investment style you actually want to take on. Do you want to do more lump sum investing to try and potentially get greater returns, or do you want to be a bit more risk averse like I was over the course of the year and dollar cost average, which makes perfect sense? And actually if the market goes down, then actually that is a better it's a better potential way to invest. But if the market goes up like it did this year, then obviously you will lose out on potential profit. So how you choose to invest is a lot more important that you choose to invest. And obviously that is the reason why I wanted to create this video, because the whole beating the market concept to me is just pointless, mate. Like really and truly it's absolutely pointless. And I think it's an argument that actually is really not based on that much fact and sentiment. Really, the sentiment for me, let me just be clear, the sentiment for me is that it's not really based on that much fact. It's actually based on numbers that are really just plucked from say Just ETF or Yahoo Finance or whatever, and actually doesn't really take into context a number of factors that actually is going to be a lot more meaningful. Because again, if I tell you that if I beat the market in terms of, if you're trying to understand whether my portfolio or my stock picks is better than the market stock picks, then you will find clearly that my stock picks were better than the market stock picks, so therefore I did beat the market in that instance. I just personally never got that return because I chose to be a bit more risk averse and I chose the dollar cost average. But if I dollar cost average now with my current portfolio versus the FTSE 100, you'll find that obviously I made more if I dollar cost average. So in both scenarios, when you take a more of a like for like approach, I believe that my stock picks were better than the market. I believe that the choices that I made were better than the market. So the whole idea of beating the market for me, I would say yes, but I again, I just don't think it's a good question to ask. Anyway, that is the reason why I wanted to create this video. And my guidance to you guys is when you're actually looking at your portfolio returns, try and be a little bit more contextual and do the maths in terms of actually how you choose to invest, as for me that has an absolute bigger impact. So hopefully you found this video useful. If you did, please like, please comment, please subscribe, and I will catch you next time with another investment video. Peace.